You buy endowments for 20 years, but you expect those kind of equity returns.
Okay.
And then maybe 15 years down the road, and you say, hey, how come my policy is like only accumulates so much? Should I go back to scold my agent?
Should I go back to scold my agent? Okay, we are back in the house today of Chills with TFC. I'm your host Reggie, aka your Chief Financial Coconut, and we are in with a legend, right? That joined the dark side.
Walao, say until like that.
So yes, Kyith, introduce yourself. I don't know if people know you, but I'm quite sure they all know your blog. You know, anybody that invests and all that. So yeah, who are you? You came out of hiding today. Come on set with us.
Yeah, I come out from back behind the blog because not a lot of people see my face around. But firstly, thanks for the invite, Reggie. It's been some time since yes. our last one. So
2 years, I think.
Yeah. 2 years. What? Didn't realize it's so long.
It's been 2 years.
Yeah. That was before COVID.
Before COVID. That's why we could meet in person. Then after that, then no more.
Yeah, so I write this investment blog called Investment Moats. Used to be more popular. Now with all the TikTok and the YouTube, which I don't do so much. So less visibility. So I've been writing that for some time. It used to focus more on stock investing and all. So eventually it ventures into more on investment management, but also the topic of what are your goals and bringing you to the goals.
Today, I got Kyith into studio to try to explore how tainted you are. How much brainwashing have you gone through? And also take the time to try to understand like what is your perspective of the wealth planning space, you know, from maybe some would call you a white knight, you know, from the outside back then. You know, like shouting out, you know, it should be done this way, blah, 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 blah.
You cannot do this, cannot do
that. Then after that, you join the dark side. So today we are here to debunk all these myths, like what is true, what is not true, what are some things that at first you thought it was like that and then turns out it is different, right? So we can start with what do you actually do now?
So I think some of my blog readers or those that saw my content,
they boycott you.
Not say they boycott, they mistaken that since I think because I put where I work on my blog, let's say you work in AIA, then they'll imagine that you are confirmed a financial advisor, cannot be facilities management person or the TMT or all those sort of things. So my official title is Senior Solution Specialist, but it's a long name for the person that is at the back end, right, supporting the advisor. So we work on the solutions, and there are a lot of aspects about financial planning or wealth management, like what goes into the onboarding process, and there's a lot of data, there's a lot of formatting or documents that clients see on a frequent basis, annual basis, and all those sort of things. So you need someone at the back end of it to actually like aggregate all these things and then format them nicely. Because Providence serves mostly the higher net worth, right? And one of the things that they want to actually aspire or plan for, right, is actually overseas education. There are a few countries, right, like how much does it cost now? What's the living thing? So you need someone at the back end to do all this research, It's this person. Yeah.
So you're not part of the sales process?
I am not part of the sales process, but in a certain sense, because like some of the more complex cases, right, the advisors come to us to actually discuss some of these things. So it does give me a certain color, like what clients are looking for, some of their concerns, and how complex some of these situations is. So I do get some of these perspectives, which is quite interesting if you contrast it against how my readers look at their own situation in terms of their net wealth is different groups and how similar or different they are. Yeah.
So did any reader boycott you? As you make the shift, did they feel like 你叛徒? So you have moved to the other side?
No, but in a certain sense, like recently there was one episode, right? I think it's more like a private episode, and it's dealing with because I sort of defended some of the influencers that due to all the cryptos kind of situation to provide a certain perspective. That my thinking is that there's definitely some, you look at it, you know that what everything or they just stop.
Yes.
Just stop. But there are some, right, in order to have this crowd and in this content and media business wrong, right, you have to preserve that reputation.
Yeah.
And in order to preserve that reputation, right, you do your own due diligence. When you're deep into some of these things, sometimes your due diligence, maybe you lack the sophistication. Although you do it, but it didn't turn out very well. Some even they do it very deep, right? Then you still have situation like FTX blow up. Yeah. I can say personally and honestly, right, I didn't expect FTX to blow up. So because I defended, and then someone actually like relate the way that he puts it across, that is that now that I joined the financial industry, like I'm not so impartial anymore. Of course, we're discussing that thing, but it's sort of like giving idea. Oh, okay, so that's how people look at it. If you go there, right, then most likely you'll be tainted in some ways. It's how tainted it is. Yeah.
So do you feel you're tainted?
I would say that before I joined, right, I have a certain idea like how the industry is. And so
what is this idea before you join? What's your perspective?
It's very sales driven, no? And then there's a lot of this kind of like possible economic bias, because let's just say that in terms of the financial advice, it's quite commissions driven, and because of the economic bias of that structures, right, it tends to be a more sales driven process. There's a lot of unknown there. The background is my friend Christopher Tan approached me whether I'm interested in that role, and I don't have to do too much due diligence because like I worked with them in the past, so I know roughly that how different things are in terms of their structure and all that. But there's always like, we join company is like that, sometimes you see what you see on the outside, what's in the inside can be totally different.
Yes.
Because of the working relationship, not a lot of due diligence there that need to be done.
So then after you are in the industry for a while, are some of these assumptions true?
I think what I understand about like that industry or in the past, right, largely is correct. Okay, really, largely is correct. And I have to like try to explain that in the sense that just now I said already that it's quite, I think there's a certain economic bias and all that. But I do have friends that are under the structure, they have their clients' interests at heart. So there is. But the problem is always that, let's say I am a 25-year-old, I come in, and then if I'm looking for financial advice, or I have some financial needs and a product, it's very difficult to actually tell like which one of them, right? It's actually good enough to actually recommend things to me. Let's say they're interested like what makes a suitable financial advisor or wealth planner or wealth advisor for you, right? Usually like you have to look for three things. Okay, firstly, integrity. Okay, this person needs to have your interest at heart. Yes. The second one is more sophistication, or what I would say competency. So they need to know how things work, like all this investment stuff and all this insurance stuff and all. They need to know their stuff. Okay, then the third one, right, is execution. They have to be kind of prompt enough for you. It's quite difficult to find these three together, because usually it's like if you have someone that is like know all these things very well, but their execution sucks, right? What happens will be like, they can tell you a lot of stories about like what investments to go into, but when you try to execute them, every time it's like wait a long time or all these sort of things. Then of course you have those like friends and families, they will suggest that I go with my cousin who is also in the wealth advisory space. So these people, they have your interest at heart, most likely integrity and all. But some of them, maybe the sophistication level is not there. It's quite challenging to find these three, and that is the landscape.
So you're saying your team has these three?
I wouldn't say that. Okay, I wouldn't say that, but because we try to aspire there, because even the sophistication part, it's an ongoing learning. I dare to say that I think all our advisors, right, they have the integrity portion of things. Execution is a company thing. It's how tightly we hold that. And that one is a function of like how well Provident does in terms of how we try to continuously improve.
I feel like I need to send you guys invoice already. Later I'll send invoice, I'll send to Provident. Say today's sponsor episode. Okay. Maybe talk a little bit about the integrity part. Right? How do I measure integrity of an individual?
I think integrity in a sense is also like it's a mixture of, let's say, trust or something. And we can think from our angle, like why do we go with our friends as advisors and all those things, is because you have a period of time to assess their character and all those sort of things and their relationship with you. So in a certain sense, like that will only be the first part of it. But in order for them to work with you for a long time, right, the hard truth is you need a period, right, to actually establish whether that trusting. And it cannot be like just like 1 meeting, 2 meeting, even 3 meetings. So it's usually like maybe a 1 to 3 years process, and probably you have to work with them over these periods to see that, we've gone through some of this market volatility, whether their recommendation or all these things is with your interest at heart. Or
that way of thinking probably works for like some of the bigger clients, right? They're more high net worth. They can test multiple advisors at the same time. You know, like my friends, they buy a lot of property. They got multiple agents running at the same time. What deal you can get me? What deal you can get me? And then eventually they will narrow down until the few people that they want, right? But for a lot of the smaller people, you know, the man on the street, the retail crowd, you get hunted down right after uni, you know. so like, how do you go about, like, you know, at that level, you know, for the mass crowd to look at financial planning as a service?
I guess it's whether it's for the higher net worth or even if your net worth is not there, right? I think the hard truth is there's no easy way. Like their general idea is farm it out, right? And then have built a relationship over time, right? And then see whether they can deliver on those 3 things. If you don't have so much money, that is a hard things to do. But you've seen most of us do that to a certain degree, because like, let's say like a lot of people, they will have potlets of money inside different robos. Why that is the case, right? And not a large sum of money in one of them, right? It's that they're testing it out, there's a lack of trust. And so it ends up in situations like that. And it's not just for those people that is whether it's affluent or below those. If you look at some of the financial, their own balance sheet, right, for the higher net worth, they also like that. So everyone is trying to do the same thing, trying to find trust and all, and everyone's struggling with it. Yeah.
So what's your hot take on robo-advisor?
I think if you look at the local ones, right, and how they evolve, right? A lot of them, they started off with, let's say, strategic portfolios, different flavors of strategic portfolios. So you can see different, that like how Stashaway is different from Scythe and how it's different from Endowas and all those sort of things. But you realize eventually, like at this point, right, the managed portfolios does not take a front seat. They started like offering like more funds, individual funds, or they lets you trade stocks and all these kind of things. So they become a platform. They are less of an advisor, because like an advisor is more like someone that tries to bring you towards your financial goals. But they are leaving a lot of things, right, to the users, right, for them to actually figure out. That is their model. And I feel that which net worth level, right, what everyone is actually looking for, right, is someone, right, to actually coach them along the way, right? Sometimes to push them along the, hey, you have $2,000 per month spare, right? You need to keep funneling it into your wealth. But it's not so, sometimes not so much of letting that person to make the decisions themselves. And because of that, right, the way that I look at them, they are not so different from the platforms that exist before that. Because the platforms that exist before that, you have your, let's say, your dollar decks, Fund Supermart, iFast and all, right. They also let you make the decisions. They have a assortment of funds, out there. They probably that time IFAS, they don't have the stock trading one. So if you look at this situation, like what's so different between them and the previous platform? So I see no differences there. It's just some slight difference.
Okay. So it's really just more of a UI and a fee kind of situation at this point in time. Because I get it, a few years ago when they first started, there was a lot of managed portfolio, okay? This one, your risk parity, blah, blah, blah. And then, you just come in, you pick, that's it. Simple questionnaire and then you pick.
Correct.
But today they are integrated with a lot of back end, right? A lot of new offerings, and then it becomes like an open platform for you to then decide. So I know I kind of know what you're saying lah. Yeah. Fair point. Okay, interesting. Yeah. So we come back to the financial planner kind of discussion. You say that a lot of things that we perceive, that means the common man that perceives on the street is true. Okay, after you enter the space, right? So after Kyith venture into the dark forest, he comes out and say, yeah lah, what you are thinking is quite true. But what are some things that at first you thought it was like that, but after you went in, you realize that maybe it's not as true?
I didn't really know that the degree is so big. Like say, for example, we always view a financial advisor or planner, right, that is able to offer two things, the insurance aspect as well as the investment aspect. For accumulation, you have your endowments, then of course you have your ILPs and all those sort of things. So I would think that I thought it was a equal pie. But when we go through some of our hiring process or even through our interactions, right, then we realize that I feel that they are more focused on the insurance aspect of things. Like their insurance knowledge, right, a lot of them, right, is quite power. Okay. It's so much that actually like in Chinese we call 盖过 their investment stuff, such that you don't see them accentuate that portion of things. And that was one thing that quite surprised me. Yeah. Then there are other things like, say, for example, how I see some of our client advisors operate, right? That surprised me, because like last time, I'm quite a numbers person, so I would think that what will actually sell, right, is a lot. You need a plan that some of these numbers make sense.
I thought so too,
Yeah, that's not the case.
That's not the case.
That's
selling is a very emotional process.
Yeah,
it's not just about hard facts.
Emotional.
Yes.
It's a very emotional, but it's more like the hand holding part. Like my boss Chris will say, this is bedside manners. So bedside manners is a lot of like those hand holding. If there's like your portfolio is down, difficult condition, how do they deliver it? Whether they take care of you first in a certain sense, like you're panicking because you're afraid of something, right? And you have to like acknowledge that fear. And before you say all the numbers, they're not going to listen, because that's not what they are concerned. Their concern is you give them this portfolio, now it's down so much. They're blaming you for it. They're angry. And how do you actually tackle some of these angriness? So that's part of it. But it's also like, what I also learned is also like, in order for you to help people, right, that sales process need to work. You need to close cases. Meaning to say you need to close a client, and a lot of times it's your presentation. So you can't just show everyone the numbers like, oh, you run this multi-column simulation, this is like 99%, all those sort of stuff. So when we go to all these kind of things, we only have limited attention. So everything has to be quite 有条有理 in Chinese.
Format, must have structure.
Yeah. Even before that, I know it's like kind of a hard truth because like, say for example, I look at some of my friends' financial situation. They are recommended by some of financial advisors that they know outside. I look at their situation on whatever that is recommended. I don't agree with all of it. Okay, like some of them, they are underinsured and all, right? But if you philosophically think about it, right, if they are not at those kind of road shows, right, and some of my friends, right, they will even be less covered. And if something happens to them, then they're in a more disastrous situation. This kind of argument, right, you can view it positively or negatively. So usually I say that this is a necessary evil. It's not a good situation, but so because you know something like that, right, like their advisor managed to close them. So over here, it's also sometimes quite sian ma. You work on a case, you really have the prospects,
interest at
heart, do all this kind of thing, but somehow or rather they cannot understand it. They cannot understand what you share with them, and they didn't come on board as a client. So you have some good benefits, but they don't get to enjoy it. Then how you help them? Like these kind of arguments, when I hear other people say, right, it can sound like you're trying to hard sell some of these things. That's my truth, lor. Yeah.
Okay. Fair. Well, that's interesting. Never thought I would hear that from you. So comment in the comment section, has Kyith gone onto the dark side? Hey, welcome to the Financial Coconut Podcast Network. I'm your host, Reggie, aka your Chief Financial Coconut. And if you're loving what we're creating here, like, share, subscribe, share with your loved ones, comment in the comment section below. And yeah, we'll see you for great content on Chills with TFC. Okay, fair. But I think another interesting thing is, in the past, you are quite synonymous with like do it yourself. A lot of DIY ideas. Don't buy this, don't do that, do this, DIY. You even publish your portfolio openly out in on your site and everything, right? So if you guys didn't know, maybe because people don't read as much these days, go to investment modes. Kyith publishes his portfolio there. When he buy, when he sell, what price, blah blah blah, everything is there, right? So you were so synonymous with DIY. Do you still believe in that? Do you still think that people can DIY?
Possible if, let's say, you are conscientious, okay, and what does that mean? Meaning to say, like, you are willing to actually put in to do the deep work. If not, right, it's not going to be helpful for you. So the whole situation that I look at it is like that. Just now I say it's quite difficult to find a person that is high integrity, have competency together. Then the alternative is, of course, you do it yourself, lah. But we are all busy people, and not everyone, right, likes this kind of thing. Even if you like this kind of thing, it's kind of like a tedious process.
It is.
So if you try to DIY, right, a good example is someone who is successful is that there's a lot of different things out there, right, that seemingly can build wealth, can help you accumulate wealth, can get you where you are supposed to go. But which one of them really works, how they work, what are their shortcomings, right? And which one is more suitable for yourself? I've been through that journey. There's a long process for you to actually like try to figure out. And you can see inside chat groups and all, right, people are trying to do that. Okay, they start off with something, then when something happens, like market gets volatile and all that, and then their stock goes down, right? They have their doubts, which is normal. But along the way, they are trying to figure out whether this method is actually right or not.
Or should I change a lane and all this kind of thing?
Or should you change your lane? So because of that can be quite a tedious process. Some people, some conscientious, meaning to say that you will be willing to put in work, go deep into it, understand some of these things better, right? Where you want to get to, right, is to find out, like, out of these different wealth building methods, right, which few are more suitable for you. You can understand like how they work. What are some of the pros? What are some of the cons, right? At the end of it, it should give you enough conviction, right, such that you dare to sink in more of your money in. So say, for example, this person, let's say we talk about that this person have a surplus of let's say $2,000 a month. Okay, when we say surplus, meaning to say like your take-home income, you minus off your expenses, this person have $2,000. So less convicted about your DIYing and all that, right? You will have potless inside these few robos. Maybe you have inside this REIT ETF, and then you try this robo, and then
it's quite a phenomenon.
Yes. Then you say, wow, some of the FANG stocks are nice, and you put in some of the FANG stocks, but a lot of times it ends up like that, and so there's a lot of cash sitting there. So those people, if you go deep into it, right, and then if you DIY, right, you get into the mechanism, right, by right. If you understand that, okay, does all this index investing work? and then you understand the pros and cons. And then if you're convicted, right, you say, okay, I understand that to build my wealth, right, I depend on the market, okay, but a large part of it is that I need to funnel the money into it. So if they understand that, then they will know that, okay, I have this surplus $2,000, or just keep funding 1,500. So these people, right, these DIY people, they can get a good outcome. I think lah, okay. Let's say you're a truth seeker, which is what I try to do like in how I carry myself, not just in work and all those things. Because if you find something closer to the truth, then you have conviction, then you dare to put most of these in. But due to how we live our life, we cannot do something like that. So I preach that, but I understand the reality, the struggles.
Yes. I get it. I mean, to be clear, some people ask me like, how can I think this way, or how do I do? So I was like, okay, you first must have a lot of time, you must have a lot of energy, and you're willing to put in the work to do these things, right? And I understand many Singaporeans are working very hard day in, day out, every week. At night you still want to study chim things, man. Or on the weekend you still want to like do a lot of extra work. If it's you, then great, right? But I also have shifted my perspective of like, okay, actually not everybody wants to do it this way, and there are other ways to go about managing it.
No, but there's certain nuance to it in a certain sense. Like if you see enough webinars, then they'll say if you have a lot of time, then maybe you can DIY. The nuance thing is it's about focus. It's a difficult thing, like how focus and all, and a lot of times it's more like consuming content, right, that is like just on one subject itself. Say for example, like some of the people that I know, right, when they started all this, they just started, let's say index investing, they'll read this book, Random Walk Down Wall Street. It's a book, okay. Reading a book, at least instead of articles, right, there's enough breadth. So at least you can understand the pros and the cons better. And then you might be able to develop greater conviction. But nowadays, with most people, they prefer to actually consume all the articles or the
short
content outside. You don't develop that depth. And that's usually the problem.
Yeah, I find it very problematic. Yes. So, which is why I try very hard to do a lot of this kind of like concept breakdowns rather than like, oh, do this, do that, I found this, that kind of content. But some people say it's very cheap, it's very cheap. It's like, I really try to water it down already, like keep it simple, break it down, all that. But yes, thank you all for tuning in every week, okay? Yes, we work hard to try to help you guys through this process. Yeah, but I also believe that to get to this part, right, in my head, right, in terms of like setting a financial plan, is a 3-step process, right? Goals, you must get clarity of your goals, what do you want? And then the plan, which is the strategy, and then after that, then is risk management. So to me, this is a 3-step process, right? Set your goals first, develop a plan upon the goals, and then manage the risk from there, right? And I think a lot of the discussion out there, whether is it with the wealth managers or robo-advisors or even content creators, a lot of people, maybe they talk more about the different strategies that are at play. Sometimes they rehash information. Maybe they read from your blog and then they just rehash the information. It's very possible. Trust me, I know a lot of these kind of things. But I want to ask you a little bit on the goals side of things, right? Like what kind of advice will you give like the millennials figuring out their life? Like what kind of goals to go for? Or do you have a framework in your head around like, how do I develop? Like this is the goal that I want.
I think in a certain sense, like you distill down very well. Like people in our industry, they don't explain like that. Okay, investment people explain like that, but like our brains are synced like that. That one is
my post-producer must put investment modes approved.
I think it's something like that. Okay, people have like different way of actually saying that. So the goals portion, right, definitely leads everything, because like why are most people doing all this? It's because they want to live the life that they want to live.
Yes.
So what does live the life that you want to live means? That you can distill down to some life goals, and usually these life goals, right, you need some financial to actually support it.
Yes.
Okay, so for all these financial goals, right, they have their own characteristics. Okay, as a technical person, that's what I'll say lah. Like my colleagues back in office, they will have a different way of saying characteristic is like a engineer way.
Which is the stuff I love. Yes, please continue.
Yeah, so these characteristics, like usually is that you look at these goals, right? Usually some of the very standard ones is your time horizon. How long do you have, right, before you need the money? Okay. Then there's also the other permutation, like how much effort can you invest in something like that? And then really like how much capital that you have, how far away it is. So these are some of the characteristics around the goals itself. Each of these goals, right, they have different kind of like characteristics that might be slightly different. Majority of them are quite similar. So give you an example. Let's say you're saving for renovations, or whether you're saving for your children's education, all these kind of things. They're pretty similar. Like you're saving for renovations, right? Usually it's like about 3 years away. Very fast. Children's education probably is maybe a 18 to 20 years thing. Okay. The characteristic is that you're saving from this point to somewhere over here, right? There is usually there's no need to touch them, right? So it's a basic accumulation, right? Those with a longer horizon, right? You can tahan more volatility. That 3 years one, right? You cannot tahan more volatility. So that is a characteristics. Now, compare that to something else. Let's say you have a pot of money. You're actually planning to be financially independent in 3 years' time. So that will mean some accumulation, but also spending down the money. Now, when you spend down the money, right, there are certain things to actually take care of. Like, how long do you need this income to last? If you need the income to last for a longer period, there is more spectrum of outcomes, like whether you're lucky or unlucky. And that might mean that you need to have enough equities inside your portfolios. If let's say, for example, this person is 34 years old or 35 years old, so technically speaking, probably 65 years going forward.
Yes. The NUS Research Center estimates that most millennials will live to 100 years old by the projection, from there. So shout out to all you centenarians. Very soon, all of you will live to 100 years old. So that's the hypothesis, yes.
So because of that, right, in order for them to last, right, the research shows it's better to have some equities. But you can imagine if we're talking about retirement, usually people will say quite a bond-heavy portfolios. So once you understand some of these characteristics, right, then you're right to say we can think about the strategies. Okay, what are some of the sound strategies for that time horizon? I will usually group that strategy and the risk management together, because like the risk management involves the strategy, but maybe you're looking at it as an ongoing basis, like how do you risk manage it?
Okay. So then now that we got a little bit of clarity on some of your thoughts around like discovering the goal, right? I believe this is a much longer discussion. How do you discover yourself? How do you define these goals? Why do you want to do these things? Blah, blah, blah. It's much longer discussion. We can do this at another time, but because I think a lot of people before tuning in may have already bought some stuff or may have already signed up with some services or like FAs or like wealth planners or even robos, whatever, right? So how do you then strike something as, this is a bad plan, or like what is a good plan?
Two things. The first thing is that there's certain, like I would say, the technical things, right, that shouldn't go wrong. Like say, for example, like if let's say you're trying to accumulate for your children's education over there, a bad plan is someone that is less sophisticated. They plan for you, or sometimes even you plan for yourself, right? Some of these, the technical part, you don't respect. It doesn't make sense. Okay.
Like you buy endowment for 20-year long kind of thing.
You buy endowments for 20 years, but you expect those kind of equity returns.
Okay.
And then maybe 15 years down the road, and you say, hey, how come my policy is like only accumulate so much? Should I go back to scold my agent?
Should I go back to scold my agent? It's like the AB move, right? Scold, don't scold.
Yeah. Then they'll go to the insurance company, complain, and then you'll make the newspaper and all those sort of things. That's one part. The other part is that a bad plan is one that you set at the start, right? And then you don't review and then you don't update it. Because life is a spectrum of probabilities. So with the technical expertise, right, we try our best to actually map out that 20 years, you need, let's say, $90,000, right, for your NUS or tuition fee. That's the plan. But along the way, right, if let's say the portfolio doesn't do so well, right, the advisors need to like review with them, right, and then say that, hey, okay, the financial products that we put you in is sound, right, but like this is not a good sequence. So in order for you to reach your goals, right, you need to like actually like funnel in more money. So say for example, like somewhere along the way, you also do well in your career, and then you have that aspiration last time that, hey, my parents sent me to Australia to study.
Now NUS is not enough.
NUS is not enough. Okay, I have the aspirations, right? I want to like see whether I can satisfy that or not. So it has to be updated.
That's like a stretch goal, right?
Yeah.
And we're not saying NUS not good. Okay, fair. I like that way of thinking about things, and I'm a big proponent of that, right? I even go so far to look at some of the gerontology studies in the UK to try to map out like how is your consumption pattern going to be like.
Wow, okay.
Right? So
that's serious stuff. Okay,
yeah. So I look at some of the studies, and there's a lot of data to show like that, because over there, you know, they have done this a bit longer, right? So the long-term gerontology study old people, okay? So I look at some of the study, and most of your consumption that you do today will peak at about 48. Okay, about 48 years old. And I think it's quite aligned with how I look at this thing. You will try less things, you may double down on certain interests. And as you double down on certain things, they don't get more expensive. In fact, if you know a lot more people in the particular, let's say you're gardening, right? And then you know a lot more people in the gardening group, your cost of pursuing the hobby comes down, right? So there's a general tendency for those things. So I like to propagate some of these thoughts so that you get a bit more clarity in your models. Right, because sometimes I feel that the financial advisor, the model is an endless upward trend. Okay, it's only an upward trend. So it's more and more and more and more and more and more. So it's an endless upward trend. And to me, you are pricing in a bit too much optionality. But you also say about the spectrum of possibilities, right? And that's something that we must respect, right? We are humans, 5 years down, you may find a partner that you want to like, okay, we're gonna escapade from this place. we're gonna elope, right? We go somewhere else, or something happened to you and you have a change in your thought process. So pricing in optionality is quite important in a plan, I feel. But how much is too much, or how much is too little? In factoring options in our plan, like having this range of spectrum of choices.
That's a good question. Actually, I try to like formulate this more recently. The hard truth is, right, if you want to be more conservative in a lot of these plans, right, basically the general idea is you put in more money, okay? And when we talk about, let's say, the spectrum of returns, right, what it means is, right, you can look at that spectrum, right, like the one at the bottom is unlucky, okay? Maybe they went through a bear market, a really, really bad bear market. Let's say, not say Great Depression. The ones usually the worst off one is the 1970s high inflation period. Then there are, of course, the really, really lucky ones, which means that they went through a circular bull market, right? Inflation is like kind of moderate, very manageable. So if you look at this one, right, it's not just one returns. It is a spectrum of considering that. So if let's say some financial planner plans for you, right, they're actually using a certain planning returns for you, let's say about 7% or 5%. The number is used for planning, but most likely that would not be the one that you experience it. So if you want to buffer for the unlucky ones, right, basically speaking, right, is like you're assuming, let's say your returns is like damn lousy. You not sure what's the plan going forward, right? But you're assuming that your returns is going to be like very lousy. Meaning you say instead of 5%, you're getting like maybe 2.5%, which is like bond-like returns for equity. Okay. So that will set aside a lot of money, okay? But we have competing goals, You can't set aside one goal. So a good way to look at this one is that at the start of all these things, right, you don't think about whether you're lucky or not lucky so much. You plan for, let's say, the median returns. If let's say use a conservative enough planning returns, right, you look at long enough history and find out what's the planning returns. Usually like it's around 5-6% for equities and all that. This will be the part where some people will be quite incredulous. Are you using too low or not? Look at the past 10 years, S&P 500 is doing how much? But if you look at longer term data, right, you realize that, okay, what we experienced in the past 10 years, right, is actually a lucky sequence. Usually after a lucky sequence, what comes after that? Unlucky sequence. So if that may be what you're experiencing, I think it's more conservative to use a more conservative planning returns. At the start most of your goals, right? You have these few goals. Say for example, let's say you're getting ready for renovations, that furnishing you have out of pocket, and of course children's costs, and then after that, once you settle some of these things, right? Maybe some down payment for your home, that one may come after that. Then maybe you start saving for your retirement or financially, these few goals. So try to factor in these few goals, right? Like plan with a conservative median returns. That will work out like how much you actually need. Then as you progress further, right, we're not sure how it will carry you. If you do well in your career, right, both your spouse and yourself, right, you will suddenly see that your income gets better. You have more surpluses. It depends on out of all these goals, right, which one is actually like more important to you. One of the key things, like before that, when Reggie talked about it, right, it starts off with goals, right. One of the key elements is that you need to, inside your head, right, you need to have a certain priority about your goals. Recently, I came out with one article that maybe a little bit controversial. It's like I explain to people what is my highest financial goal at this moment, which is to make sure that I have enough financial security. So to me, out of all these things, right, that one is the highest out there. And you might disagree with that, right? But you have to like work out some of these things. Like for some, right, they believe that children is their future, right? And being able to pay for it, that ranks quite high, higher than their retirement. That is maybe higher now. You have to have that inside your head, right? And usually when we're talking about this, it's more like a little bit long drawn out, maybe 5 or 6 years, those kind of goals. If you have that idea about what's your priority, right? When you have this surplus of income, right? In order to make your goals more certain, right? You divert more of this additional surplus to those goals. Okay? Now, we'll see how the market moves from there. If let's say you are lucky, you turns out to be lucky, right? You can lower the risk for these portfolios, okay? So that subject to less volatility, since you have already achieved that goal already, additional resources you divert into the next priority lah. So that's the blueprint to tackle this, which is why you see when we go back to what's a good plan or what's a bad plan, right? It has to be constantly reviewing some of these things. Either the planner do it for you or you have to like do it yourself. Yeah.
I like that frame of thought, right? And fundamentally that already factors in that optionality involved, right? Like you have some basic lineup, you prioritize, and then if you have more, if things perform better, you can do more, and you don't need to over plan. I think that's a decent reply. But we can keep evolving this question, right? Because we can be more sophisticated on modeling some of these things, like how people consume, what their major expenses, blah blah blah. On top of the goals lah, pretty much.
But I think also the important thing is like we have to listen to a perspective of your clients. And for this one, it's more like listen to your own perspective. If let's say you're doing it yourself, okay? And this has to be layered together with some technical sensibility. Let's say, for example, right, because we have those kind of like prospects or clients come to us, right? They have already made their wealth already. But what they're unsure of is like, how much is enough? Okay? If you, let's say, I want to send my children to NUS tuition, how much is it? Now, the tuition fee 1 year is 10,000. 4 years, 40,000. 20 years down the road, inflation, whether it's 3%, 4%, roughly 90,000, 100,000. That's a figure. If you have a lot of money, right, in order to fulfill this goal, just remember to set aside. Either you want to put it inside a balanced portfolio, just put 50,000 inside so that you'll grow somewhere there. Or if you're conservative, just set aside 100,000 for it. These are easier. The retirement one, right, financial independence is tougher because
there are too many moving parts. The goals the goals are varied. Yes.
Yeah. And a lot of people say different things about it. So everyone is like trying to figure out like how much is that enough number.
Yeah.
So they come to us for that, right? And we have like software to actually determine things like that. But a lot of times, right, we have to find out some of the client's perspective about some of these things. Like say for example, if the market is not doing so well, right? How would you spend your money? Are you okay to actually instead of spending 5,000 per month, right? You spend let's say 3,000, 4,000 per month, and most of them, right? They are quite flexible, people understand that they are quite flexible, but there are some. You can imagine that they say, I need 5,000. They have their own perspective, but there is some technical things, right? You cannot violate one. It's
first principles.
It's things like that. Say for example, they only have $400,000, right? And then they want to have, let's say, 35,000 in income per year. Mathematically, cannot one, no?
Yeah.
So that's why these two things have to marry. You have to listen to them, but at the same time, that's what they're coming to you for, to get those numbers more correct. Yeah.
Fair. Cool. I think you've shared a lot. Great stuff. Closing one last question. So if someone is thinking of joining the space, financial planning, wealth management, what is one liner you have for that?
Walao, this question is hard.
It's like what a keng for you to jump in.
The controversial answer is or the career planning answer is you have to understand the landscape that you're jumping into, whether it fits your character or not. A lot of times I think talk to enough people in the industry and all that, and try to make sure you know who you're talking to. Someone that is maybe more neutral, maybe they're more experienced, that they see all these things.
Not trying to recruit you guys.
Yeah. It's like say, wow, how much can you earn in your job? Like that, you come over here.
A lot of fear mongering.
Yeah,
yes.
Yeah, you see, in 3 years' time we will have a Jaguar. Or all these sort of things. I don't think everything would actually fit your character nicely, because sometimes you don't really know yourself that well. But it'll be different. This kind of advice is different if, let's say, you're fresh joining in without so much baggage versus someone that wants to transit.
Mid-career, let's say a mid-career. Someone that's, now 行情派, times are hard, and people are thinking, maybe I should leave my manufacturing job, or I should leave my, I should join the financial space, and then financial planning becomes an option.
I think it's trade-offs, like what you gain in your industry if you continue to stay. Like this job sucks, right? But if you jump to another place, is it better? Because sometimes this place sucks because the boss sucks. So that one is a easy problem to fix. Unless you have jumped enough, then you realize that all bosses suck. Okay, then that one probably is a problem. Okay, so usually mid-career switch, right? It depends on your financial situations, because a lot of my colleagues, not say a lot, some of our associate advisors, they're doing career switches. Like one of them is he has his own family business, general manager, right? He decided to switch over. Another one, right? He works in a government organizations, and then he switched over. So a lot of times we also try to help them. We try our best in our interview process, right? To make sure that they have that characteristics that has a high chance of succeeding. And then they're coming into Provident, right? For the right reasons. Because if, let's say, we don't do a good job, then also not nice, let's say that if it doesn't work out, because they're taking a lot of risk when they do these kind of things. But for most of them, what we observe is that you got to take care of your finances well before
you can be a good financial advisor.
Yes. If this is what you're actually looking for, but if, let's say, you're a hunter,
yes,
and then you're actually looking for sales and all, then it's a different matrix, right? You got to understand whether all these things, if you jump from those IT sales job into this one, right, are you going to still earn better compared to that one? So different metrics.
Cool. Thank you. Thanks for coming on the show. Okay, so 3 money questions. Number 1 is, what has been your best and worst investment you've ever made?
I don't have best investment. Like the best investment, if best investment is like those make 200, 300% that I can proud of. Like, unfortunately, don't have like a lot. It's like if I make money, right, it's like the capital size is too small. Okay, so that's the hard truth lah. Like I'm disappointed with myself. Worst investments, I have crypto investments. They all went to zero. And bad judgment lah. Really bad judgment. You let go of a lot of like traditional risk management. And all that. If you go down to zero, confirm is a bad, but I wouldn't say there is like one that like
stands out to be the worst.
Yeah. Whether it financially impairs me, don't have.
So we need another episode to talk about investment modes, crypto losses.
Walao, might like that eh?
Okay. Next question. What's one thing under $100 that has been a game changer for you?
Probably two. Okay, not game. Okay, one of them is like one of the cups. One of metal, like those kind of like cups that keeps drinks.
Thermal flask.
Okay, the thermal flask. Why is a game changer is because like that thing itself, right, is like wow. And then is instead of you needing to open it, it's like a cup like that. So you just slide and then you can open. And these are some of the things that will encourage you to actually drink more. Because every time you are doing your work and then you see the bottle and then you want to drink, right? And I'm not the ones or kind of that get thirsty very easily. So I have to force myself to drink. So your brain will be thinking, hey, you need to open it up and then...
So you reduce the resistance.
I reduce the resistance. But the surprising thing is also like, it really holds the temperature quite well. Because it's cost me $17. You all can go to Shopee and buy. It's under this brand called JML. And then it's called Arctic. Okay. Yeah, I'm not sponsored by them. Okay.
I would love to be sponsored by them. So please can contact us. Yes. Last question is one place you learn that you think is underrated.
I think this website it's A Wealth of Common Sense by Ben Carlson, right? I think it's a good blog because all the articles are pretty short. Let's say you're holding, a broad-based diversified portfolios, right? It's good for you because it has a lot of data, but it tells all these data in stories that is very relatable, and they're not like my articles. They're short. They're short. So
if you have not seen his articles, you should go and take a look. So A Wealth of Common Sense.
A wealth of common sense for those people that is actually interested in, let's say, broad-based investing. Right? There's this guy called Ben Felix. So he runs a podcast called Rational Reminder. It's a very good podcast, and where I got to know him is through his YouTube videos, right? That he breaks down some of these things, whether we talk about, let's say, factor investing, index investing, right? What is the research behind it? It's quite thorough, and then it's quite well broken down. If let's say you're investing that way, right, that might be something to actually check out, because it will help you go deeper into whether you can get like higher conviction into this way of investing.
Okay, thank you. I appreciate your time.
No issue.